Todd is from FIIG Securities and joins us from Sydney. Mark, one of the concerns kind of swirling around the banks is this worsening Eurozone debt crisis. A lot of them will say, look, you know, a lot of people are saying to us, banks haven't got a great exposure to Greek bonds or anything. But I guess it's the systemic worries that people are talking about. How do you see the risks of that issue spilling over and affecting our banks?
Oh, I think our banks are well covered in that respect, but I think the systemic risk that people talk to is the funding of the banks, and so you're just part of the collateral damage, if you like. The banks have made a great effort to try and change the funding mix so that they went from, let's say it's 45% in locally funded deposits, that's now closer to 54%, and they wanted to try and move away from that wholesale funding piece. You know, you're out there in the European markets trying to fund banks, you'll just find investors will be naturally cautious.
So because the Moody's talked of the reliance on offshore funding, but you're saying they have already reduced that reliance.
Correct.
So that mutes the impact of that, or? Yeah,
that's right. And you saw Mr. Smith from the ANZ said it was a curious way to deliver your information. The banks have, the data is fairly clear. The banks have made a greater effort on the deposit market, and so I think we all know that in hindsight the ratings agencies are much more cautious. So if they're seeing 45% wholesale funding offshore, they're saying that's now too high, whereas a few years ago it was acceptable. So the banks are making greater efforts in terms of that deposit market and locally funded. Yeah,
and Chris from IG Markets was saying, from a stock point of view, people just can't see the catalysts here, and a lot of people are talking about the credit growth outlook for the banks and why that just doesn't look as good as it used to. How are you seeing that affect some of the the term deposit rates out there in the market?
Well, the credit growth is the greater concern. It's fairly anemic, and when we go and meet with the banks, they can't on-lend, so it has a natural effect on. At the moment, it's not necessarily too much lower in the way of rates, but it's the volume of money they're looking to borrow. So they're not borrowing the same amount of money. They still want to be in the term deposit because of that previous mention about the BAL, about being in deposit markets. But if you were borrowing $10 today, tomorrow you might only borrow $8.
Where do you see the best value at the moment? What kind of rates are you looking at?
Well, it's that in that 1 year bucket around that longer duration. Again, it's in that 620 to 640, 650 rate. So they're pretty good rates, and the banks still want to have that longer term funding from a deposit base.
What about some of the mortgage rates around? We're hearing earlier in the week NAB offering some much better rates through its kind of online bank, Ubank.
659 for Ubank. I mean, that's there's your $64 question. If you're issuing mortgages at 659 and you're borrowing money at 620, 630, and there's no margin at all. I mean, you can't fund the business that way. So something will have to give over time. Clearly, it's a loss leader for the banks in that mortgage war, which is part of the NAB separation from the other three. It's just a question of what the other three do.
What about higher rates that might be forced through the rate rise that's expected from the RBA?
Well, again, it's we think the jury's still out on that rate rise. If you look at the data points that are coming out at the moment, there's enough to say that the Reserve can be slow to move. So it's a function of course, if there's rate rises, the banks will have to pay for higher rates because the cost of funds will be higher. So that's common sense, but I'm not sure when that rate rise will happen.
But I think people are tipping kind of rate rise in the third quarter. Do you think that's underestimating the risk, considering the rhetoric that's come from the RBA recently?
I mean, I think the RBA has been very consistent. They've always said it's going to be at the end of the year that they'll review it. They've expanded the inflationary number to 3.3, and they're saying clearly that in the fourth quarter is when they think they might have to move. But the data coming out at the moment saying it's all very benign. So I don't see them moving in the third quarter, to be honest.
What number?
And I'm against everyone else.
Yeah, okay. Because what numbers could change that? Is there a number that could be kind of a tipping point, and you would kind of go along with the rest of the market? Is there anything you're watching?
The things that we're watching is any of the wages numbers, most importantly, and in the savings, consumers. So the consumer behaviour is very important. So if they continue to save the way they are, they don't spend the way, because they're clearly not spending, and the wages growth is limited to the mining related pieces, we think the Reserve will sit back and wait.
Fantastic. Thank you so much, Mark. Todd, great to get across all of that with you today. Thanks.
Take care. Bye-bye.
Yeah, Mark Todd there from FIIG Securities.